The International Monetary Fund, or IMF, is a lender of last resort. Backed primarily by taxpayers in the United Nations, the IMF gives out loans at low interest rates to countries that are in financial crisis. But the IMF doesn't simply hand out loans. Those loans come with stipulations, first called structural adjustment programs, and since having been given a series of other names. Essentially, the IMF demands a series of economic reforms meant to stabilize the economy, cut government spending, and lead to long-term growth and debt reduction. The IMF's critics say that at best it's not a very effective organization, and at worst, it's an agent of neocolonialism, trapping developing nations in a cycle of debt and economic dependency that they may never escape. So let's look at the IMF, its history, the impact of its loans and structural adjustment programs, and what it all means. The IMF was established at the Bretton Woods Conference of 1944, a post-World War II conference that reshaped the global financial system. Initially, the IMF functioned to oversee the global fixed exchange rate until the 70s, when it transitioned into being a lender of last resort for countries experiencing financial crisis. Unlike the UN, where decisions are based on one country, one vote, decisions in the World Bank and IMF are based on investment dollars, giving the United States the only veto in both organizations, as well as the ability to pick the president of the World Bank and the only permanent seat on the board of both organizations. The US has been able to use the IMF as an agent of foreign policy, with wide-ranging effects, as we will see. To understand these effects, we can look at three key areas around the IMF: how the loans themselves have created a cycle of unsustainable borrowing, where the basis of their economic policies came from, and the impact of those policies on the countries that have borrowed from the IMF. Let's start with the problems with the loans themselves. Back in the 1970s, oil prices skyrocketed. This meant a few things. First, countries that exported oil had a lot of extra money, which many of them invested into international banks. Countries who didn't have oil had to pay a lot more to get it. Countries in Latin America fell into both of these categories, notably Brazil, Argentina, and Mexico. These countries borrowed huge amounts of money from international creditors, initially organizations like the World Bank, but later private banks that had an influx of cash from oil-rich countries and were looking to profit off it. These loans were in part to deal with the rising cost of goods, since oil was so much more expensive, but also were used for things like large infrastructure projects. The problem was these Latin American countries had very few safeguards around these loans, and the private institutions who were lending the money were not adequately calculating risk. For example, Mexico took out a number of loans where they borrowed against future oil revenues, indicating an assumption by both Mexico and the lenders that oil prices would remain high indefinitely. In the 80s, the price of oil and other commodities crashed, and Latin America's debt quadrupled in just a few years. Mexico declared in August 1982 that they would no longer be able to service their debt, leading to the Latin American debt crisis. In response, banks stopped lending to Latin America, so debts that would have been refinanced became due immediately, making things worse. In stepped the IMF, who offered to give Mexico a loan to keep them from defaulting. But let's be clear about who these loans are for. If you're a country that's about to default, a loan from the IMF does not protect your citizens. It protects your creditors. Private banks made risky loans to Mexico, often based on the idea that commodity prices would stay high indefinitely. When those risky loans went bad, those private banks didn't suffer and weren't punished. Instead, they received payments from the IMF, with Mexico as the middleman. This sent a message across the world. If you are a private bank or financial institution, it doesn't matter how risky or thoughtless your loans are. At the end of the day, if a country can't pay them, the IMF will bail you out. Bad loans like these were largely responsible for the Asian financial crisis of 1997, and historians and economists have criticized the IMF for creating the conditions that led to those loans. This is one of the earliest examples of the cycle of debt that has continued on from the 80s to today, where developing nations become increasingly dependent on external loans and exports, while less and less government money is able to go to growing their economy or creating social services, as more and more goes to interest payments on debt. Mexico was also subject to a structural adjustment program, which had disastrous impacts on Mexican citizens. Which leads us to our next question. Where do the policies behind the IMF's structural adjustment programs come from? The answer to that dates back to Chile in the 1970s. In 1972, Chile was not doing well economically. Inflation was at 150%. In 1970, Chile elected longtime politician and socialist Salvador Allende. In his presidency, he hoped to nationalize various industries in the country and improve the economic condition of the working class. Although due to leading a coalition government, he had difficulty accomplishing many of his goals. From the beginning, the United States and the CIA worked to undermine Allende's presidency. Internal documents from September 1970 show a concerted effort between Richard Nixon and then head of the CIA Richard Helms to, quote, make the economy scream in Chile. The United States took on an incredibly antagonistic foreign policy towards Chile, cutting off their import of important goods and preventing the World Bank and IMF from giving loans to the Allende administration. Many Chilean buses, for example, were unable to run due to the lack of tires in the country. The efforts of the US and CIA damaged Chile's economy. In response, Chile's central bank printed currency to address the increasing deficit, resulting in high levels of inflation. In 1973, the United States' plan came to fruition when the CIA backed a military coup that killed Allende and replaced him with dictator Augusto Pinochet. In the years leading up to the coup, Chile and the US had a cooperative education agreement between the University of Chicago and the Pontifical Catholic University of Chile. Some budding Chilean economists were educated at the University of Chicago under influential economist Milton Friedman, among others. Friedman has since probably become the most important economist in the global shift towards neoliberalism and free market capitalism. Those Chilean economists came to be known as the Chicago Boys, and they played an important role. As Pinochet came to power, the Chicago Boys were given prominent positions in his government, shaping Chile's economic policy for the next several decades. They were accompanied by a document called the Brick because of its massive size, a huge textbook documenting desired reforms to Chile's economy, authored by the Chicago Boys and, of course, the CIA. These reforms were wide-reaching, involving massive deregulation and privatization. They cut tariffs, opened the country up to foreign investment, reduced taxes, and made central banks independent. These types of reforms are often called shock therapy for two reasons. First, they're often implemented during a time of crisis, a violent coup, a natural disaster, a war, an economic collapse, times when citizens are too distracted to notice the gutting of the social services they depend on. The second is because in the short term they're often extremely damaging to a country, but are intended to have positive long-term effects. In the case of Chile, Milton Friedman labeled the coming years as the miracle of Chile. The Chicago Boys' economic policies became the basis of the policies of Margaret Thatcher and Ronald Reagan, and of the IMF. For at least the next 3 decades and arguably longer, the IMF would use the types of policies that reportedly saved Chile as a blueprint for nations in the global south seeking loans in times of financial crisis. Their austerity measures almost always meant deregulation, privatization, and opening countries up to global markets. If it worked for Chile, why wouldn't it work in other places? Except, did it work in Chile? In 1974, the year after Pinochet took power, inflation reached 375%, the highest rate in the world and almost double what it had been at its highest rate under Allende. The following year, Chile's GDP fell by 13%, industrial production dropped 27%, and unemployment increased by 20%. But this is shock therapy, so the long-term outcome must have been better, right? Chile fell into its second recession in 8 years in 1982, a recession that lasted more than 2 years. By 1987, 45% of Chileans were below the poverty line. Things only started to improve significantly in the 1990s, after Pinochet had left office, allowing Chile to return to a democracy. While Chile continued to adopt neoliberal economic policies, they also adopted new social policies with a focus on poverty reduction, leading to GDP growth and a 20% reduction in the poverty rate. Today, however, Chile is one of the most prosperous countries in Latin America, with a low infant mortality rate and relatively long life expectancy. Defenders of the free market point to the Chicago Boys and their free market policies as the reason for this. Yet there are a few things to consider. The first is that Chile's economy, prior to Pinochet's military coup, was intentionally sabotaged by the United States. So at the time when the Chicago Boys started implementing their economic policies, they were starting with an economy that was even worse than it should have been, and now had the cooperation of the US, which should have led to a rapid turnaround. Despite that, it took nearly 20 years for Chile's economy to see any meaningful growth. In fact, it got much, much worse for a lot of the next decade. Chile is even a perfect use case for the implementation of these policies. They're implemented under a dictator, with no one to raise opposition or criticize the government, lest they become one of over at least 40,000 Chileans who were victims of political violence during Pinochet's reign. So did these neoliberal policies help Chile's economy? Maybe. If they did, it took a long time and caused a lot of suffering in the interim. But the point is, they did not conclusively work. And there's nothing to say that another approach would have worked better, with fewer short-term consequences. Yet they became the basis for the IMF's structural adjustment programs. The miracle in Chile had far less to do with Chile's economic recovery, and instead on its transformation into an economy that serves the United States. In 1975, Chilean exports to the US were only 8.6% of total exports. By 1985, they had risen to 22.4%, making the US their largest export destination, more than double any other trade partner. The IMF began using SAPs in earnest during the global debt crisis of the 80s. From 1980 to 1993, 70 developing nations were under 566 stabilization and structural adjustment programs, resulting in a transfer of $178 billion from the global south to Western commercial banks. A Canadian former director of the World Bank compared it to the conquistadors' looting of Latin America. There is a logic to the requirement of SAPs. They demand that countries reduce government spending, sell off publicly held assets, and cut the public sector. But these decisions have short and long-term consequences. In the short term, poverty increases dramatically, wages drop significantly, mortality rates climb, and life expectancy drops. Basic necessities like healthcare, education, potable water, and electricity, which often were once subsidized, see rising user costs. SAPs typically demand labor flexibility, meaning fewer protections for workers, which decrease wages and open the door for exploitation. Opening up the country to foreign investment and removing protections for domestic industries can stimulate investment, but also allow multinational corporations to eradicate local industry. In Peru in 1991, in exchange for a $100 million loan, Peru had to open the country to US corn. Within 4 years, corn cultivation had fallen tenfold in the country, and the production of coca had risen 50%. A largely agricultural nation, the production of cocaine became one of Peru's main economic forces, leading to corruption across huge swaths of the economy and government, as well as an increase in the global trafficking of cocaine. These effects are seen dramatically across sub-Saharan Africa, where 36 out of 47 countries have been subjected to SAPs. From the perspective of the IMF, all of the numbers look exactly the way they would expect in a best-case scenario. From 1990 to 1999, trade as a percentage of GDP rose from 78.1% to 95.6%. Foreign investment jumped from $923 million to $7.9 billion. Portfolio investment for equity increased from $2 million to $3.9 billion. In simple terms, sub-Saharan Africa massively increased trade, and foreign investment increased substantially. The SAPs worked as intended. Yet from 1960 to 1980, sub-Saharan Africa's GDP per capita grew 36%. From 1980 to 2000, it fell by 15%. Between 1994 and 2003, the number of people in that region living under the poverty line increased by 75%. Per capita incomes for many countries fell by 25% in the 80s. Life expectancy dropped 15 years to only 47, the lowest in the world, from 1980 to 2004. In that same period, sub-Saharan Africa's debt has increased 500%, paying more in debt interest payments than on healthcare. Governments that have undergone SAPs almost always find their level of debt rising over the coming decades, as SAPs typically demand that foreign investments and the businesses that come from them have low tax rates, meaning that for all the money that comes pouring into the country, the government of that country actually doesn't tangibly benefit much, meaning they can't make substantial payments on their debt, locking them indefinitely in a cycle of being unable to make significant public investment to stimulate the local economy or establish a social safety net that will alleviate poverty, instead relying on global markets and largely the West to fuel their economies enough to continue making interest payments on their debt. In the 80s and early 90s, Ghana's government owned over half of all gold mining in the country, their largest economic industry. The SAP, beginning in 1986, opened mining to foreign control by implementing incredibly favorable investment opportunities, including almost the complete removal of income tax and duties. Over the next 20 years, nearly 85% of Ghana's mining operations became foreign-owned, with production hitting record levels. Yet these companies have contributed very little to Ghana's economy, as they pay very little taxes and most of the profits end up in foreign banks out of the country. The IMF also gave out loans and applied structural adjustment programs throughout Eastern Europe in the 80s and 90s. Their policies helped to create the Russian oligarchy we see today. As Russia transitioned from a communist country to a capitalist one following the fall of the USSR, the IMF gave Russia a loan that required that Russia privatize many of its public assets. Those assets were largely given or cheaply purchased by political elites in the country, who then fought any attempts to introduce competition into the market and put much of their profit into foreign banks, resulting in huge capital flight. The IMF was aware that hundreds of millions of dollars of their loans were disappearing due to corruption, yet continued to lend to Russia anyways, as it supported American foreign policy. Meanwhile, Russian citizens experienced a dramatic decline in their quality of life, including the largest peacetime rise in mortality ever experienced in an industrialized country, as well as rises in inequality and poverty and lower life expectancies. These same measures have been pushed across the world by the IMF with disastrous consequences for the poorest citizens of borrowing nations. In the late 2010s, Ecuador borrowed $4.2 billion from the IMF and adopted the austerity measures that were demanded of them, including cutting their healthcare spending by 64% and cutting over 3,000 public jobs in the sector. This led to Ecuador being vastly underprepared for the COVID pandemic and experiencing one of the deadliest outbreaks in the world, as well as one of the largest increases in inequality and poverty following COVID, due to their government's inability to provide stimulus due to IMF requirements. This is despite claims by the IMF in 2014 that the period of structural adjustment programs was over, and the IMF was instead going to focus on pro-poverty reduction programs that considered the input of local authorities and civil societies. And to be fair, the IMF of today is much different from the IMF of the 80s and 90s. Their recommendations are at times less aggressive and do consider some input from local governments and community leaders. But an in-depth study showed that 23 out of 26 IMF loans in 2016 and 2017 contained austerity measures, and that the number of conditions attached to a loan are actually continuing to increase. Those austerity measures continue to today, despite SAPs now being called the Poverty Reduction and Growth Facility. Defenders of the IMF point to countries like Poland, which received IMF intervention in the 80s and is now one of the healthiest economies of Eastern Europe. And I'm not denying that Poland has become a healthy free market economy. But in just about every positive example to show how shock therapy works, the country's economy has not recovered for years or decades, doing so only after a series of other factors, like governments, commodity prices, trade agreements, or social policies have changed. It's difficult to draw a straight line between the IMF's intervention and a healthy economy unless your goal is to do specifically that. What is easy to do is to show the suffering of average people in countries who are forced to adopt austerity measures in times of crisis. These programs overwhelmingly cause wealth inequality, an increase in poverty rates, lower life expectancies, higher mortality rates, poorer healthcare outcomes, an increase in the cost of basic services and living expenses, and higher infant mortality rates. A paper from the Boston University Global Development Policy Center found that the IMF's intervention in 79 countries between 2002 and 2018 were significantly associated with the highest earners receiving more at the expense of the bottom 80%. But the question remains, what is the alternative? After all, countries are coming to the IMF in times of crisis, due to external factors, yes, but also due to years or decades of poor economic policies. Of course, these things are going to hurt in the short term, but is there another way? The most radical solution that has been proposed is to simply forgive the debt of borrowing nations in the global south. Although extreme, many of these nations feel that their debt to Western countries came as a result of imperialism and colonialism. And therefore, in order to be able to become independent, these debts should be forgiven. There is virtually no chance this ever happens. The IMF and World Bank do forgive portions of debt at times, and charge low interest rates on the debt they do give out, but they're funded by UN nations who will not allow the money that they have contributed to simply disappear. Allowing countries to default and market forces to correct institutions that gave out bad debt is likely no longer a viable solution, as it may have been in the 80s. The IMF itself has acknowledged what likely the best course of action should have been all along, which is to implement policies that focus on poverty reduction and raising the floor for a country's poorest citizens, rather than implementing sweeping neoliberal reforms. Yet, despite acknowledging this, the IMF continues to push countries in the direction of deregulation, stabilization, and privatization, even as these programs have taken on a different name that feels more optimistic. Many countries have increasingly criticized the IMF and World Bank in recent years, and some have refused to borrow from them altogether. Some of those countries have instead taken loans from other places, increasingly from China. Unfortunately for countries in the global south, colonialism is unescapable, and loans from China come with their own Trojan horses, with a different set of dire consequences. That's in part 2.